change the whole pattern. Remember, when you see a pattern, it should be obvious. Okay? It's obvious that we've got a bullish wedge here. This over here is not obvious that we have any kind of wedge. Okay, that just looks like a box where we've got about the same highs, about the same lows, got a breakout range, and we can see that the market eventually just falls off. Okay, I'm looking at the clock and I see I've still gone longer than I wanted to, but I think I got my point across. Again, I really think the main idea that I'm trying to get across here is that you've got to be aware of and looking for what's going to happen if my analysis is incorrect. What will the market look like? Don't just immediately assume that because the market starts just moving up a little bit that your position is incorrect. Yes, I do believe in using stops because it protects us against those really aggressive moves where we just panic and we're frozen. And we wind up getting out at a bad time. In fact, a rookie trader here who went short early here and who held on is probably just going to uncle out. I mean, they're just going to say, "Oh man, I can't take it. The market's moved up 100 and some odd points. I just have to get out." And right after they get out, boom, the market starts moving down. That's because, you know what? Everybody who went short there's puking out right there. That's why you see this huge bar. There's a lot of buying going on over there. But then, there's no follow through. So everybody pukes. The shorts just finally say, "Oh crap, I got to get out." The smart money, the market makers, they're all short up there, and then the market finally comes back down. And, this can be devastating for traders because what they think is, "Oh, if I would have just held on, look at this, I would have made a fortune." Not realizing that, to get that fortune, you had to sit through a huge, huge drawdown. So anyway, that's, I think stops are they're good for that, especially for rookie traders. Pros, some of us will use a little bit different technique, maybe not necessarily a hard stop, where we'll actually let the market make this kind of pattern first before we get out, because we know that the market will typically give signs that it is starting to move. And every once in a while we'll get caught with a big move against us like that. But that's trading. Anyway, so stops are a very, very good idea. They help you to contain risk. They help you to get the emotion out of position that's moving against you. But then you can evaluate. So if you do get stopped out, which let's say you get stopped out here, and the market starts just whipping all over the place. Well, listen, you already know that resistance broke once. So it should be support. So now support breaks. Now resistance breaks. Now support breaks. So you know that this resistance area, at least for the time being, is not going to be honored, but you should be looking for additional signs. If the market's going to go up, you should be looking for signs of a bullish wedge. You should be looking for signs of some kind of triangle. You should be looking for signs of, pennant pattern, etc. Okay, so again, if the market's going to go up, what am I going to see? If the market's going to go down, what am I going to see? If it's going to go down, you probably see something like this. Of course, a bearish wedge is what I call that. Again, the pattern is going to be evident. It's going to help you to plan ahead. It's going to help you to confirm what's going on in the market, but it will also help you to identify those areas where the market is doing something that you don't expect, and possibly even something that the market's going to do against your opinion. It's about 30 minutes. I'm going to go ahead and wind this up now. I'm already starting to feel a little bit drained. Anyway, hope you had a great weekend. I wish you a very profitable week. Good fortune to you, and God bless.